Lots of numbers for us to chew on, those watching the U.S. economy. Joining us now to try to make some sense of all this, Steve Hanke, the professor of applied economics at Johns Hopkins University. He served on U.S. President Reagan's Council of Economic Advisors. His most recent book with Matt Sakurki is Making Money Work, How to Rewrite the Rules of Our Financial System. Welcome back to our program.
Great to be with you, Sean.
Okay, the economy grew by 3% in the second quarter, beating expectations, yet the Fed downgraded its economic outlook. How would you reconcile this?
I think that the trick here is you really have to look at what happened in the first half of the year. And the first half of 2025 is weaker than the first half of 2024. So things are getting weaker. Things are slowing down. That's how I'd characterize it. And I think the reason for that, Sean, is that the growth rate in the money supply, which was really the fuel for the economy, is anemic. It's only growing year over year at 4.5%. And my golden growth rate, a rate consistent with hitting a 2% inflation target, is a little over 6%. Let's just call it 6%. So money growth is slow.
Right.
It's been slow for a long, now over 2 years, 2.5 years. And so I'm in the camp of it's slowing down, and it will continue to slow down throughout the year.
With that information, let's talk about what Chair Powell had to say about the Fed, that it is not very close to cutting rates. But we have this open disagreement. I want you to weigh in on that, how significant you think that is, and using the past as a yardstick. This is certainly something Trump could very well pounce on. Do you think the Fed is being overly cautious right now?
No, I don't think Trump or the Fed have the thing right. They're focused on interest rates, and monetary policy is not about interest rates. It's about changes in the money supply. And therefore, they're focused on the wrong thing completely, both Powell and Trump. So the conversation's just, in a way, irrelevant in terms of the reality of the economy. And the reality of the economy and where it's going is dependent on the growth in the money supply. They've got to get that up. And there are two immediate things they should be talking about. One is to stop quantitative tightening. No one talks about that. They talk about interest rates and the Fed funds rates, but they're engaged in quantitative tightening, shrinking the balance sheet of the Federal Reserve. They should stop that. They should have stopped it a long time ago. The second thing, most of the money produced in the economy is produced by commercial banks. Right. About 80% of all the M2 money supply is produced by commercial banks, and they're constrained by various reserve requirements that they have to follow. And one of those is a supplementary liquidity ratio, and that actually is one thing that the Fed is talking about correctly and talking about removing it. They're recommending that it be removed. That would take a constraint off the commercial banks, and they would be able to at least have the potential to make more loans to good projects.
Let's talk about Trump and his tariffs. With Trump pressuring for rate cuts, despite what you just laid out for us, and at the same time imposing new tariffs, how is this policy tension affecting market confidence?
So far, it doesn't seem to be having any effect on the market. No matter what happens, the market just seems to go up. I think the market is in a bubble. According to my bubble detector, it's definitely in a bubble. The problem is, Sean, once a market is in a bubble, we don't know when it will pop or even if it will pop, because maybe the air will just slowly come out of the thing and the bubble will disappear. Maybe something will trigger a pop, but we don't know which alternative will occur, and we don't have any idea when that might occur, what the time frame looks like in the thing. But the fact of the matter is we're pretty much, I think, in a speculative frenzy right now, and all you have to do is look at the stock market or look at cryptocurrencies. Look at Bitcoin. I mean, Bitcoin is a speculative asset,
right.
But it doesn't have any fundamental value, and it just goes up, 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 up.
Okay, so the way you're talking, I think back to the 90s when the term irrational exuberance was thrown around. I'm old enough to remember that very clearly. With the labor market remaining strong, according to the Fed, some officials do see these warning signs. You talked about the bubble. If indeed that does pop and doesn't come out slowly, what could it do to this, not only the economy in the U.S., but the global situation?
Oh, I think the house of cards that Trump is building with all these tariffs and these interventions and so forth would come tumbling down so fast it would make your head spin. That's what would happen. I mean, if the bubble popped, the house of cards would crumble, and the trade deals, by the way,
right?
That we talked about this. You had somebody you interviewed a little earlier saying, well, we know more now than we did then, and things are settling down. But the thing is, these trade deals, they aren't deals. They're oral agreements. They're not in writing. No one knows what in the world is actually in the things for sure. And the way Trump behaves, if he doesn't like something, he can turn around and change it the next day. I mean, so I think this whole idea that somehow this is again the irrational exuberance. The irrational exuberance on trade is, oh God, it could have been a lot worse. You know.
And we're going to talk a bit more about that later in our program.
Let's wipe our forehead and double down in the market and go in with more margin and everything else. You know, you just name it.